think is the single biggest risk to U.S. equities right now?
There's a really good paper that was written by a guy by the name of Cliff Asness at the hedge fund AQR. And, self-made billionaire, extremely good quant analyst in looking at markets and different asset classes over time. And he writes a ton. You should check out a lot of what he's written. Anyway, one of the papers he wrote a number of years ago was a look at what he calls our old friend, the Shiller CAPE ratio. So just about everybody's familiar with the simple concept of the PE ratio, price to earnings, as sort of a general referendum on how rich is a stock's price relative to the underlying earnings power. So the step that the Shiller PE takes is it says, well, earnings are inherently pro-cyclical, right? When you're at or near the top of the cycle, earnings power is going to be a lot greater than it is at the bottom of the cycle. So instead of looking at PE on a single snapshot basis, meaning 1 year, the better way to do it is to look at the trailing 10 years worth of earnings relative to the current price. So Shiller's got data that goes back, I believe, to 1890. And what Cliff Asness did is he looked at the subsequent 10 years of return in the market, depending on where you started out at that moment in time on a Shiller PE ratio. And what he found is that if you break those starting points into deciles, meaning you're in the 10th decile, the most overvalued, the bottom decile, the most undervalued, and so forth, the subsequent returns were exactly the same as what your starting multiple was, meaning the higher the multiple, the lower the return. And they're monotonic, meaning...
Oh, they were, okay. The returns were reversed, basically.
Right.
Okay.
So the higher your starting Shiller PE multiple, the lower your subsequent 10-year return. And what he found, actually, is that...
It seems like a very simple concept.
It is, but you'd be surprised how little simple counts for.
Yeah.
And the point is that when you're in your top decile of valuation, your subsequent 10-year return is around 0. And for 10 years.
Yeah.
And what's interesting is that the cutoff point for that Shiller PE ratio is a multiple of right around 24 or 25 times. And right now we're at 27.
Oh, wow.
So we're solidly into that 10th decile, which based on the last 125 years worth of data suggests that the subsequent 10-year return will be 0. So that is, without a doubt, the single biggest risk to the equity markets is that you've got over a century's worth of data to show that the returns over the next 10 years are going to be terrible.
Yeah, wow.
Which is one of the reasons why, in my opinion, a buy and hold strategy over the next 10 years is going to do terribly, right? So, the proper way to think about it is, there's always going to be spots where you can make money. We're going to do our best to help you sidestep things that are going to obviously not do well, but if you just sit parked in equities for the next 10 years, you're not going to make any money. That's just a fact.